I'd like to welcome you to another session of the Friday Chart Clinic, but today we will do it differently, and this time we will do it uh, by a special presentation that I prepared for all our like members and premium members to actually look at the closing bell stock pick. And basically, what we do on our Traders Truth Review Premium website, I think most of you would have know that every Friday on 4:15 we have our closing bell session. Some of our like member may know that we do this have the video recorded and make it available to all, but you have not seen the full version of it. So this is one way to actually look at it, the stocks that we have picked. But what I want to do is to share with you the results over the year 2012, the closing bell stock pick. And just give you a bit of background. Every Friday there will be 3 stocks that will be picked. 2 from the KLSC side and 1 from the SGX. Now this stock pick is not so much as a stock pick, it's more like a case study to really look at volume spread analysis. Okay, so it's and these are for short-term trading, short-term strategy. Okay, for the longer term fundamental investing, look at the monthly stock market comment for that one. Okay, so that's the other one. This is for the short-term one. Okay, so a little bit on the background now. As I said before, we normally pick 3 stocks from the KLSC and from the SGX. Okay, so since we beginning of last year, sometime in January 2012 to now, we have picked about 100 stock pick. Now, how we pick them, I'm going to go into it later. But the result that we have here is from the month of April to the December, the last date of December trading month, which is 2012. So all in all, we have about 100 stock pick. And actually we pick them using the volume spread analysis, or another name called as VSA, volume spread analysis. We actually have this technical stock filter, and we teach you as well as give you, together with the software, the filter, and the meta stock, in our main course. Okay, for those of you who don't know, we are doing our main course next week, March 2nd, 3rd, and 4th for that one. So those of you who is interested to come to our main course, we still have a couple of seats left. Let me know, and we put you. And if you do come for the main course, we will give you this technical stock filter that you could use it yourself to pick this. Okay, and again, the third point is that we do the stock pick in here. Now, what we have on the right hand side is actually the returns after the stock pick. Let's say, for example, we pick it on Friday, right? Because the stock pick on Friday. Monday is the day that we would enter. Okay, and then at the end of the Friday, there will be 1 week, and then the second week, the third week, the fourth week, the sixth week. So this is like the period of returns. If you were to buy and hold it, what kind of return you get? And we spend from the first week all the way to 36 weeks, which is equivalent to 9 months. So if you have held the share for 8 weeks, which is equivalent to 2 months, what kind of return would you make? Do you like to see this? Just want your feedback. What do you think of this? Okay. Okay. So this is typically how we actually look at the stock pick. Now let's talk a bit about short-term trading. Most people would have traded short-term. Now, if you ask everyone what is short-term trading, everyone will have a different definition. Some would only have it for 2 days, some will have it for 3 days, some will have it for 4 days. But if you look in terms of a longer period, very little studies has been made in the period of holding it. So this is actually a study based on the stock pick using the volume spread analysis and what happens if we hold it. Right, I did ask around on the like subscriber as well as premium members, typically on their short-term trading, how long would they hold it? Okay, so most people actually give me sometime between 2 months, 3 months, and some people, buy it for short term, right? However, when the market sell off, they did not cut loss, and then they end up holding it for a long time. So this is what we call a short-term investment turn long-term. Now, don't make the same mistake like that. Okay. How many of you can recall this feeling of buying something for short term but didn't cut loss and end up taking it as a long term? Anyone have this experience? Just share with me. I'd like to hear feedback. Okay. Right. No one. Everybody did very well. Okay. Everyone did very well on this one. You have some feedback. So when the short term, you keep it for the short term. Any feedback? I got about 30 people. All right. So I don't have any feedback from the group. Now this is actually looking at a survey on the. Oh yes, finally we got some. Okay. Yes. Everyone too shy to admit mistake. Yeah, Tech, that's right. Okay. So this then again, that's good. Thanks a lot, Tech. So this is how we look at it in terms of the kind of average return. That average. Now this is a study done by from BlackRock, from Stansberry Group, a well-known research group in US, which I do subscribe to it. It tells about an average investor in US context. Okay, this is in US context, and my personal belief, anything that is reflected in US also tell a story what's happening in our market too. I mean, we are not that different from the investor in US as well as in this region. So what it simply says that the 20-year annual return by asset class from 1992 to 2001, it simply says that the average investor, again, there's a good question or post. Someone did ask, what is an average investor? What compromise and what constitute an average investor? Now, let me tell you about my experience with average investor. The average investor are people who don't do their homework, people who don't have a plan when they come to the stock market. Average investor will listen to their broker, or listen to the newspaper, or listen to the talking head. Immediately they say something, especially on the stock pick, and they will buy it. Right? However, if you are an average investor, that is what you tend to do. You will buy things on impulse. You won't do your due diligence. You will not check on company. You will not even use premium services like what we have on our premium website. You tend to use things which is free because you think, hey, free things is good, right? So that's what an average investor do. And my personal belief, most average investor in this market lose. And why is that? Simply is because they follow the herd. Now the mentality of following the herd, I've talked a lot about it in the books that I've written, the last few books, Dividend Don't Lie, as well as the Supercharged book. That tells you that most investors don't do their homework, and if they do their homework, they will do well. As a matter of fact, this average investor return over the last 20 years is only 2.1% return per year. Now, if you compare that with other stocks, if you just buy and hold maybe on some good shares, you might do much better, right? So do you think this is says a lot about truth about what's happening in the market? What do you all think? What do you think, Norm? We have some audience in our room here.
So the question, oil was
Yep.
92 was a depression in the oil business. So now it's quite good. So the question, stocks, gold, oil, the bonus. I don't know about bonds. International stocks.
Yep.
So everybody knows.
Yeah, that's right. Now, if you look back the last 20 years, stocks, especially this book written by Jeremy Siegel, stocks will always do well, and which is quite true. I concurred with this result return, that if you invested in stocks 7.8%, we are locking in a period span about 20 years. Of course, those of you who invested in the property may tend to disagree with me. You have a good run. You make 30% return every year for the last 5 years in property. I met a few property investors had claimed that, and I believe it's true, going where they are. So if you have not been through a bubble in property, like some of my friends in US been through, they have not seen a bust in the property, so they won't realize that this thing ever happened. But all in all, do be careful. Economic go through a boom, go through a bust. It happens in stocks, it happen in oil, and it also happen on the property sector, which is experiencing a boom in Malaysia. Go on to that. Now, if you look at the distribution of the return, now this is a very interesting slide in here. I just want to explain the returns for each of this is the return based on week 1, second week, third week. If I go back my slide correctly, yeah, 1, 2, 3, 4. What it says is the longer period that you hold, the better it gets. Okay, the longer period that you hold, it gets better. Out of the population of 100 stocks, we did have some making as high as about 55%. There was only one stock that actually went down to as minus 60% in here. So all in all, you would say that the average return that we have is simply between around the 12 to 15% return. Now this is what we call a scattered graph. Okay, it's a scattered graph to tell you out of the 100 stock pick that I have, the kind of return if you hold it in the first week, second week, third week, fourth week, sixth week, 8 weeks, 12 weeks, and subsequently, just to give you a distribution of returns. Now, of course, an average trader who looks in comes to our website won't be investing or trading these 100 stocks. Okay, so you gotta have as what did I say, a favorite sector that you want to pick, or maybe you want to pick stocks that they have certain price reaction, certain charts in there. So it's going to be tough to really pinpoint how people average out the return. They may have out of the 100 stocks that the members are exposed to, they may have only picked 2 or 3 stocks, and those 2 or 3 could have done very well, giving a 30 to 40% return if they follow this system, or they could do just as on the bad side, doing a negative return, maybe because of exiting. Now again, one of the big part that we found with the investor is the emotion. Now the emotion is one of the strongest factor that affects people. When there is a lot of fear, people tend to sell it out. Okay, when there's a lot of greed, people tend to buy in when prices are rising. So that's very important. So that is why, to be a good trader, you got to control and manage your emotion very well.
So the chart goes flat after a while.
Yeah, it does goes flat. Let me just get on to next slide. Now this is a shorter time frame when you look at the returns. This is for the first week, second week, third. So you'll notice typically as you extend the returns, okay, these are for the return that is less than 20%. Only a small percent that actually made less than 20% return. This is between minus 10 to 20%. They all follow some sort of a pattern in here. Most of them actually have a high occurrence between either a negative single digit return or a positive single digit return in here. So this is just looking at very short term to tell you the kind of return that we're talking about in here. Alright, okay, next slide. Now the average return per trade simply tells you a very interesting story about all what we have in here. Okay, of course commission are not included. Now if you look at the average return per trade, you will notice the longer you hold it, the better it becomes. Right? Now I remember in a lot of my slides I always say that if one trade you can make 30%, take it. Would you all take it if you can make 30% return? What would you say to that? Okay. Alright. Yes. Okay, Henry will say yes. Alright. Now, what is the minimum return that will make? Okay. Okay. Now, if you look in the scheme of things, why we do this? Because we want to have a realistic target for the kind of return we want to make per trade. Typically, you can, if you're investing, then the return per trade tend to be a bit longer, right? It's possible to make 100% return for a single stock in 3 years. Now, if you're talking in the short-term trading, this is the kind of return we're talking about, between 7 to 8% if you hold it up for about 24 weeks. Now, how many of you agreed and disagreed with this kind of return? What kind of return have you made per trade? Have you ever considered that? Right? Yeah. Have you all considered what kind of return have you made average it up per trade? Right? Do you all get what I'm trying to say here? Okay, about 5% return. Okay, anybody else? 5 to 8%, 3 to 6% return. Exactly. Exactly. That's what we're saying. So if you are doing a short-term trading, right, and you want to make the 5% return, 6% return, you got to have a time frame. A lot of people, when they come to my closing bell, as soon as I talk about the stocks, they bought it on Monday, right? And then if it didn't go up on the first 2 days or the first 2 weeks, they say, hey, your stock didn't move. So I told them, look, there is a period that you have to let the stock, take its natural course. If it's going to go up, it's going to go up. So what we have seen far here, this is, to me, I was really surprised that you can make a good entry, on any of your stock, provided you allow the trade to take its place, right? As you can see, the highest return in here gives about a 7% return. So generally, I would say a good approximation for a return per trade is about, I would say, maybe 5 to 6%. So if you can make 10% return or 12% return per trade, hey, that's very good. And if you can do it almost every month, that's you're talking about something like 120% return, right? So this is some sort of a strategy for those of you who is thinking of doing trading as a full-time business. Okay, this is a strategy that you should be thinking if you're doing a full-time basis. And remember, the closing bell that I have is actually targeted for short-term trading, because a lot of people they have bought the stock based on the stock pick, but they don't know how to exit, because my job is not to tell them to exit. Remember, the premium subscription it's an education to train them, to educate them, to tell them they have to master themselves, right? It just tells you, give you the avenue of it. How many of you agreed and disagreed what I've just said? Okay, we got some feedback. They can't hear me. Okay, because if they were to hear, then there'll be too much noise. There's too much bandwidth. Then it won't be smooth. Okay. Good. Take guts to sell. Yes, that's right, Henry. So great. Some of the responses I've been getting are very good. It makes sense too. So if you are first time coming into this market, a lot of people come in with very high so-called expectation. They come in that hey, the stock market is going to be make me rich too. Now remember, in property, right? We talk about property. If you can make 30% return per trade in property, is that good or bad? For those of you who are property investors, I'm sure you know what I'm talking about, right? 30% return per year. Yeah, that's good. Okay. So simply what I've said in here, generally to make the 7% return, you got to have it for 24 weeks. Now 24 weeks, that's about 6 months time frame. Okay. So if you have that, you got to allow a time period for trade to work its way. Okay. Now, next thing we want to do in terms of the return, we look at the total returns, where we combine the total returns, and it equates up to it. Now, for the first week, the percentage of return, we are only talking about 49%, which is, to me, surprisingly, was quite good. Most of them actually make money. 50, or very close to 50% of the trades actually wins. Okay, and if you sum up all the winning trades, you get about plus the losing trades, you still end up with a 65% return. And this tells you simply, the longer you hold it, of course, you reach to a point, it's follow a very what we call a bell curve. a normal distribution. Now, a lot of people, if the trade doesn't make money, they tend to hold it longer and longer. And you'll notice at week 32, 36, 28 weeks, 36 weeks, let's look back to this, is almost 9 months. So the key point here is you want to be holding around the 16 weeks and the 20 weeks time frame. And that would give you the best. So of course, people wanted to have a higher percentage of winnings, may want to keep it a bit longer. So this actually gives you a time frame when you bought your stocks, right? At the end of certain period, let's say 8 weeks, 12 weeks, which is about 8 weeks is about 2 months, you should be in the money. If you're not in the money, that should ring an alarm into your system that something's not right in here, right? And if you do the trades in out, you should get the kind of return. Now, like the 16 weeks, it's about 300% return.
What is it? I'm not sure. What is it in percent of winning?
If you do 10 trades out of this, if you make 56%, means that's almost 5.6 trade percentage of winning.
50% of your 56% of your stocks are positive.
Of winners. You see, the problem is most people. Okay, that was a good question. Someone asked, what does a 56% mean? Also, a 56%, if you look in the trade of 100 stocks that we have in there, on the second week, 56% of them are actually in the positive area, making money. So if you held it a bit longer, that number actually grow. Okay, not that much, around 50, but it did reach a high point at 60. So what I'm trying to say, there is a relationship based on the time period that you hold to your percentage of winning.
So what is the sum?
The sum means you just add up all the percentage for that winning trade. It tells about the 344% here. Because you're winning more, your average win per trade are more. So that gives you, in this example, a 300% return. If you held all your trades, of course we are looking at the perfect scenario here, right?
So the index is what? What is, when you first go, what is the sum?
The sum is all those percentage as well. I'm going to explain to that, okay?
So that's not clear. It looks like if you hold it for 36 weeks, you lose money.
Oh yes, it does. So if you hold it for, if you hold your trade, if you exit on 16 weeks, and if you follow those 100% trades and you get in the price, then you would make about 344% if you buy all 100 stocks. That's what we're talking about. Okay, so that's what we mean actually. That's hypothetically for a person who have a lot of money, can buy 100 stocks and really trade in and out. Okay, but however, if you put in the commissions, that's why it's very important for those of you who is trading in and out, make sure your commissions are relatively low. Okay, do what I make this make sense to you guys? Because this is the core fundamental to the mechanics or the mathematical side about trading. Of course, most people never get to that, because when they say they trade, they only made 3 trades a year. you see my point? So 3 trades a year, they've been only trading for 5 years, so all in all, they only made 15 trades. But remember, if you are the trader, you got to be doing trade in and out very, very often. Then that makes you a trader. Do what I say? What this makes sense? Okay. Because this is an important part about being a trader. Okay. Okay. Now, if you look at the trading case study, a time expiration exit. Okay. If you're looking at a trading case study, now we're looking at time expiration exit. Because a lot of people tell me, look, if your trade doesn't pan out, what is the best time to get out? Okay. Based on the study that I have, this is a question that I always get in my blog. I bought a stock, it hasn't gone anywhere else. Should I exit it? All right. So we have found out that there are 3 choices here. The best time to exit: the 2nd week, the 8th week, which is the 2 months, and the 16th week, which is the 4th month. So you got an option to enter 2, 2nd month, or 4 month. So that will tells you the reason why we do this is because, remember, when your money is stuck in your trade, and especially if you are trading, you're not looking at dividend yield, so you're not getting anything back. However, if you're investing, that's okay. You're still getting the dividend yield, about a 5% yield. Now remember, the average winning per trade in here is about 7%. Now, if the dividend yield you're getting is about 5-6%, that's a year, which is not too bad. So that is important. Your money as a trader must not be tied down. It should be kept as liquid as possible. When you see an opportunity, you go ahead and you do it. Okay, so this is a very important as part of your strategy to, especially for my premium members, I owe it to them to have some sort of a strategy how to do it. So again, let me re-emphasize the time expiration exit, preferably with 2 weeks, 2 months, and fourth month. Okay, if you hold it a trade. How many of you agreed or disagreed to that? Okay. All right, good. Okay. So now this is a case study on a biosensor for SGX market. Now you can see a lot of time, market just doesn't move up. Now this is a case where on the second week, you notice when the signal first came to us on the 7th of December, which is a VSA stock pick that came out on my filter. But remember, those of you who comes to our main course, you will get the VSA technical filter. We'll teach you how to use it, and this is one of the filters that I spent many years refining it and really make it available to all our traders in here. And this is as the closest thing to holy grail, to make money, to pick up the filter. Now if you notice this part here, and when it's activated, you'll probably enter somewhere around here. However, the first week the stocks actually dipped down, not much, just about 5 cents. But however, on the second week or going to the third week, the stock really propelled and actually going a bit higher. Okay. Heng Hong, are you saying that I will make 300% if I buy and stock folio for 16 and 12 weeks? Of course not. These are the example. If you have buy 100 stock, can you buy 100 stock, Heng Hong? Now what we are trying to do, Wing Hong, here on your question, is to have the probability on our side. Your probability would be the best if you hold it for somewhere between 16 to 24 weeks. However, you must have a plan. So that is why you must have a plan where to exit, where to take profit. Okay. What is IMR group? What is the IMR group, Henry? Okay. Okay. Now what I've shown you here is a study on the last year's stock pick that we have. So this is nothing of an opinion, but this is all facts. Okay, these are all the data that I have, and I spent about a week with my intern to crunch the number up to really present this to you. Okay. So in summary, we're getting to it. The closing bell case study, we compared to the overall market returns, we do show that the closing bell case study have superior returns, as we have seen. Second point is that the percentage increases with the length of holding initially, but decreases if you hold too long. So that is another benefit. Hypothetic making of a 3-digit return is possible. It's a reality, provided you have a few good runs, you do what you are trained to do, you let the profit run, and then you take partial profits. All those things we actually teach in our main course to really do it, right? Of course, this is the same thing. If someone teach you, if someone give you a Formula car, a F1 fast car, would you become the best driver in the world? No, right? But at least it's possible, provided you have the right training, and that's what we want to do in our main course. Oh, okay. What is this about? Henry, you want me to look at IRM code 7220? I don't understand you. Okay. So the fourth point is have a plan with the right tool and be consistent with your trading. When we say have a plan with the right tool, means getting a stock filter like a volume spread analysis, building up your plan and really trading it, and always try to be in the market. And you notice since the 2012, every week we have free stocks in the market. and that way we won't actually miss the market at all. We won't because remember, market do sell off, and when they do swing back, it swing back higher. This is important because reason why I say that, a lot of people say when they're trading, but actually when you actually go a bit deeper, they only trade 1 or 2 times a year, and to me that's not trading, that's investing. If you are trading, you got to be constantly in the market. So the only way to do it is really have a tool and a system. Okay. So finally, we recommend the volume spread analysis as a trading method, and we are giving out the volume spread analysis stock filter in our main course, which is coming up on 2nd, 3rd, and 4th next month. For those of you who is thinking of coming, we still have a couple of seats left. And David, you mentioned you wanted to come. I haven't heard anything from you. Are you still interested to come, David? Oh, too bad. What's too bad means? Book ticket on book. What's that? I don't understand what you wrote. Book ticket on following week. Book ticket on the following week. So March 2nd. So our main course. Oh, you're planning to travel on March 8th. Well, you're planning to travel on March 8th. We are doing this on the March 2nd to 3rd. Yeah, but okay. Don't give yourself too much excuses. If you're traveling on March 8th, you still can attend the course. Okay? That's a problem. That's a reality. A lot of us give us too much. Okay, so before I end it, just a bit of promotion for our premium membership. Now we will have a special promotion for new premium member sign up. This is for the new premium member sign up. So if you want to look at how our closing bell going forward, we have a 3-month premium membership plus the use of the magic scanner for 3 months, or you can subscribe to the 1-year premium membership with we'll also get you 3 months of it. Now we are giving a 10% off from the current prices, and this is for our half-year promotion sale. Okay, so if you want to email me to get this premium membership off, and it is going to be for 1 month only. This is for the premium membership sign up. Those of you who want to, you get a 10% off, and it will be for only 1 month starting today until end of March 2013. I think most of you who has been a light member would have known about this premium membership, and I don't like to say more than that. So take advantage of the 10% off. We're doing a half-year promotion in here. So that's all I want to talk about my premium membership and also on our main course. Okay, so that's all I have for the closing bell stock pick revisiting short-term strategy. Okay, highlighted a few points in there. Hope you all learned something today. Now I'm open for some questions, and hopefully I'd like to answer them too. Any questions that you all have?